How's it going on, everyone? And welcome back to the channel. In this breakdown, we're taking a deep dive into support and resistance, not just what they are, but what actually makes them work. By the end of this video, you'll understand why price reacts at a certain level over and over again, how liquidity, order flow, and psychology shape support and resistance, biggest mistakes traders make when marking levels, how to identify the zones that institutions actually care about, on how to use these levels to trade with precision instead of guessing. And if you've ever joined the lines perfectly and still got faked out, this will explain exactly what happens and why that happens. So let's get straight into it. Most traders think support and resistance are just price floors and ceilings. That's the beginner's explanation, and it's not wrong, but it's incomplete. Support is simply an area where buying pressure has outweighed selling pressure in the past. Resistance is where selling pressure has dominated. But the key is why that happens. It's not about lines, it's about orders. When institutions buy, they need liquidity, meaning they need sellers on the other side of their trades. So when price drops to an old support, that's where retail traders start selling, thinking the market's breaking down. And that's exactly when the big players step in to buy from them. The opposite happens at resistance. Price pushes up, retail buys the breakout, and smart money sells into that liquidity. So support and resistance are reaction zones. Reaction zones where liquidity pools exist, where smart money hunts for inefficient traders. Okay, now let's take a look at this example. As you see, this is labeled support, and this is labeled resistance. Why? Because whenever price taps into support, price automatically gets rejected, sending it the other way, meaning that the big buyers have stepped into the market to push price higher other than keep selling, meaning that the big buyers have stepped into the market to reverse price upwards. And in the case of resistance, it means that the big sellers or big institutions has came into the market to reverse price lower. As you see, every time price reaches support, it gets rejected. Rejection here, rejection here. And the same also can be said for resistance. Every time price reaches resistance, it gets rejected. So support and resistance zones are basically rejection zones where price tend to go towards, and the big institutions and smart money, they look at those zones to reverse price and to get liquidity. Now, how do you identify valid levels? Strong levels can be identified by studying past rejections rather than price touches. A valid support or resistance should have all three of the following: a clear rejection followed by an impulsive displacement, meaning if price touches a level and drifts sideways, it's weak, and if price hits a level and aggressively reverses, it's considered strong and it signals institutional activity. The next is minimal noise around the level, meaning excessive wicks or indecisions indicate absorption rather than rejection. And the last is a clean structure lead in, meaning price should approach the level with clarity, not with choppy consolidation. Once identified, these levels should not be marked as thin lines, but rather as zones, with the top and bottom boundaries taken from the wicks and the body closes. A next factor that you should be aware of is how price reacts when approaching a level. When price approaches support or resistance, it typically reacts in one of three structured ways. It can have a immediate rejection, meaning price taps the level and reverses instantly. This suggests that liquidity was consumed efficiently and directional intent was already determined. The next can be consolidation at the level. Price stalls and grinds across the zone, and this indicates absorption and indecision. often meaning a sign of preparation for expansion. And the last can be a break and retest, meaning that price pushes through the level, gathers liquidity, and then returns to test it from the other side. A break and retest often implies role reversal. Each scenario signals a different order flow condition. You have a level that rejects price and often acts as a short term pivot. You have a level that consolidates, absorbs liquidity until one side is overwhelmed. And you also have a break and retest, often implies role reversal. Let's shift our attentions and look at some live chart examples of some support and resistance zone. So here you can see that this is a valid support zone and this is a valid resistance zone. Why? Because every time price comes to this zone, we have a strong rejection from this zone. We have a strong and immediate rejection from this zone. And every time price comes to this resistance zone, we have a strong and immediate rejection by this zone, followed by an, a displacement, a small fair value gap. And also can be said with this, with a big fair value gap. Now let's fast forward and see how price plays out within these zones. So as you see, price then returns back to support from being rejected from resistance to then give a big bullish engulfing candlestick. And this suggests that the big buyers and institutions within the market has shifted their attention from selling to buying, giving this big bullish engulfing candle. Now, let's see how price shifts from bullish and reacts to this resistance zone. So, immediately when price touches this zone, you'll see a big bearish engulfing candle, meaning that the sellers have stepped into the market to push price down. And let's see how this plays out. And as you see, price has been pushed down after immediately touching resistance. All right, that wraps up today's breakdown. If you're rocking with this style of trading content, make sure to subscribe and stick around. I've got plenty more coming. This is the Trading District, and I'll see you in the next one.